you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined by Morningstar's Matthew Rogowski to talk about retirement. Hello Matthew.
Hello.
So we've been hearing today at the Morningstar Investment Conference how different retirement strategies around the world are different and similar to those in the UK. And one of the most striking things about the US I found is that as a nation we are moving away from annuitizing in the UK. They've been tarred with this sort of they're all bad brush, and actually in the US take-up of annuities is increasing.
That's interesting. I think what we've found is that commonly, and this is something that existed in the U.S. a little while back, in that the same misconceptions, the same, I'll say, skepticism was certainly there in terms of the cost of those annuities, their role in the portfolio, and I think it was unfortunately more of a binary decision. You either used an annuity or you did not, right? If you were an advisor that saw value in them, you tended to allocate quite significantly to client portfolios, or you didn't. And what we saw then is, quite frankly, with the financial crisis, a movement away from annuity purchase, and you saw a stagnation in that market. I think what we found, though, is that when used appropriately, right, as a tool within a portfolio setting, they can create that floor level of income, right? So it allows an individual investor to sit down and say, okay, what are my discretionary expenses? What are my non-discretionary expenses, right? What is the minimum floor I need to actually support my needs in retirement? And utilizing that annuity in that fashion actually changes the dynamic of the discussion. Again, it's not that blunt instrument, it's very surgical, it's very tactical, and it's used within that client's overall portfolio. And I think within that conversation or that context, more investors are willing to, again, allocate smaller portions of their portfolio, total portfolio, to the guaranteed income options.
And that's, I suppose, that flexibility is already there in the mind of the investor, in the mind of the person approaching retirement, because in the US you've never had to have this compulsory annuitization. And I think one of the reasons that they have such a bad name in the UK is maybe it's just human nature. We don't like to be told what we have to do. Correct. And choice is an attractive thing.
That's right, yeah. I mean, that pendulum, right, has swung. I think it'll find an equilibrium. And again, I think it's incumbent upon service providers like ourselves and others, advisors, product manufacturers, to really educate, again, the appropriate use, right?
And one of the things that I thought was interesting about what you said is the concept that it's not just individuals who are choosing to annuitize. There's this thing that is quite popular in the US, a retirement savings plan called a target date fund, which is basically pooled investments that works toward a particular date. Sure. You have high risk assets at one end, and as you come towards retirement, it gets less risky, and then you can then either choose to sort of go into a drawdown structure, but you stay within that sort of that product, don't you? Sure. They're increasingly becoming popular in the UK, and target date funds in the US are using annuities to help provide some sort of income in retirement.
That's right. You know, again, I think one of the biggest challenges we've had in the U.S. retirement marketplace is inertia, right? Again, I mentioned that investors talk about that. You know, they think, they believe, they feel that they have enough money, when in reality they really don't, right? And so these target date funds were used as a way to manage risk, right, throughout that investor's life cycle, to ensure that the nest egg that they're able to accumulate is protected as their horizon risk grows. But again, we got to the point where, all right, now as we move through retirement into the spend down phase, investors were now left to their own devices, right, in terms of how they intelligently spend down. And so the new developments are really focused around making sure, in a measured way, again, very appropriately allocated to within the portfolio, that there is a baseline level of income that's now secured in that target date offering. So overcome that inertia, provide that base level of income. But I still believe strongly that it doesn't alleviate the need for that advisor, right, that trusted advisor, to sit down with that individual investor and say, okay, you have this income option now, right? But it's highly dependent on the balance that you accumulate, which is highly dependent on the savings rate that you adopt. And so guiding them, coaching them that you may feel safe, you may feel secure, which should only mean you need to up your savings rate even more, right? Those things together, I think, can really have a significant impact on investors' outcomes in retirement.
Matthew, thank you very much.
Thank you very much.
This is Emma Wall from Morningstar. Thank you for watching.